This is not speculation. This is not hype. This is a red alert on silver. The silver market is flashing the same warning signals it did before every historic price explosion. But this time, the pressure is far greater, the system is far weaker, and the upside is far more violent. Today, I'm going to explain why silver could surge toward $330, what must break for it to happen, and the exact timeline scenario that makes this move not just possible, but probable. This is a red alert, not a suggestion, not a forecast buried 5 years out, and definitely not background noise. The silver market is entering a critical pressure zone where history shows one thing happens, and it happens fast. Silver does not drift higher when stress builds, it snaps. What investors are seeing right now is the calm before a violent repricing, driven not by optimism, but by systemic fear. Before we go any further, if this breakdown is hitting home, take a second to subscribe and switch on notifications so you stay ahead of what's coming next. Also, drop a comment below and let me know where in the world you're watching from and what time it is right now. This channel spans the globe, and I always like seeing how far this conversation reaches. Leave your location and local time, and I'll see you in the next one. Across global markets, confidence is thinning. Debt levels are exploding, currencies are being quietly diluted, and trust in financial plumbing is eroding beneath the surface. Silver sits at the center of this storm because it is both money and necessity. Unlike paper assets, silver cannot be printed. Unlike gold, silver is consumed daily by industry. That combination makes silver uniquely dangerous to a fragile system, and uniquely powerful when that system starts to crack. The warning signs are everywhere, but they are subtle by design. Paper prices are being held down while physical demand tightens. Inventories are shrinking as industrial users lock in supply. At the same time, investors remain distracted, conditioned to believe silver is boring, volatile, or dead money. That complacency is exactly what precedes every major silver move in history. Silver explodes when no one believes it can. This red alert is not about chasing price. It's about recognizing asymmetry. The downside is limited by physical scarcity. The upside is driven by panic, currency stress, and a loss of trust that cannot be reversed with a press conference. When silver finally moves, it does not ask permission. It bypasses resistance levels, ignores forecasts, and forces the market to reprice reality in real time. This is the moment when prepared investors pay attention and late investors pay up. Silver is on red alert because the market structure itself is breaking under stress. This is not a normal cycle. This is a pressure cooker built from years of artificial suppression, rising demand, and reckless monetary policy colliding at the same time. Silver has been priced as if nothing is wrong, while everything underneath it is screaming that something is very wrong. First, silver is deeply undervalued relative to gold. Historically, silver has traded as real money alongside gold, not as an industrial afterthought. Today's extreme gold-to-silver ratio is not a sign of stability, it is a warning of distortion. These distortions do not resolve gradually, they correct violently, and when they do, silver doesn't move in dollars, it moves in multiples. Markets hate imbalance, and silver is one of the most imbalanced assets on the planet. Second, the silver price you see is largely a paper illusion. The futures and derivatives markets represent enormous claims on silver that does not physically exist. Paper contracts can be created endlessly, physical silver cannot. This gap between paper promises and real metal is widening, and history shows that when physical demand challenges paper control, price loses its leash. The moment confidence in paper pricing cracks, silver escapes. Third, the supply side is tightening at the worst possible time. New silver discoveries are rare. Mining costs are rising. Production growth is flat while consumption accelerates. Silver is being used up, not stored. Once it's gone, it's gone. Unlike currencies, silver does not come back with a keystroke. This is why silver is flashing red. It is trapped between scarcity and denial, between real-world demand and financial fantasy. When those two worlds collide, silver does what it has always done. It reminds the market what real value looks like. When Jim Rickards issues a warning, markets should listen. Not because he predicts prices, but because he understands how systems fail. Rickards operates in a world most investors never see: national security briefings, war game simulations, and stress tests designed to answer one question: what breaks first when confidence collapses? His focus is not optimism or growth, it is fragility. Rickards has spent decades analyzing financial crises as weapons-grade events, not market cycles. He studies what happens when currencies lose credibility, when debt becomes mathematically impossible to service, and when central banks are forced to choose between collapse and debasement. In those moments, silver stops behaving like a commodity and starts behaving like what it has always been: emergency money. That is why his warnings matter now more than ever. What Rickards consistently emphasizes is this: markets do not fail linearly, they fail suddenly. The illusion of stability holds until it doesn't. When trust evaporates, capital does not rotate politely, it runs. And when it runs, It seeks assets with no counterparty risk, no balance sheet exposure, and no political promises attached. Silver fits that profile perfectly, especially because it is still massively underestimated by the public. Rickards' concern is not about short-term price action. It's about the invisible fault lines forming beneath the global monetary system: sovereign debt spirals, currency wars, and policy desperation masked as stimulus. These pressures do not unwind peacefully. They culminate in resets, and resets always expose which assets were real and which were illusions. When Rickards sounds the alarm on silver, he's not selling excitement. He's signaling danger and opportunity, because in every crisis, the biggest gains go to those who recognize the warning before the headlines forced everyone else to see it. The $330 silver price projection is not fantasy. It is math colliding with monetary reality. This number doesn't come from hype or hope. It comes from studying how silver behaves when confidence in paper money breaks, and the market is forced to reprice truth overnight. Silver does not move like stocks. It doesn't climb stair steps. It revalues in shocks. At the core of this projection is the historic relationship between gold and silver. For thousands of years, silver traded as real money alongside gold, not as a sidekick. When monetary systems come under stress, that relationship snaps back, often violently. Today's extreme gold-to-silver ratio is not normal. It is a distortion created by paper markets, leverage, and financial engineering. History shows that when this distortion corrects, silver doesn't just catch up, it overshoots. Now layer in currency debasement. When governments inflate away debt, gold reflects the loss of confidence first. Silver follows with leverage. If gold is revalued to levels consistent with sovereign debt, currency dilution, and balance sheet expansion, silver does not politely lag behind. It accelerates. A $330 silver price is not about silver becoming expensive. It's about currencies becoming worthless relative to real assets. The final ingredient is psychology. Panic changes everything. In a crisis, investors don't ask what silver should be worth. They ask what they can still trust. Silver's small market size turns rising demand into explosive price action. There simply isn't enough physical silver to satisfy a global rush for safety. That scarcity forces price discovery upward, fast, and disorderly. This is how silver has always moved in resets: quiet neglect, sudden disbelief, then vertical repricing. $330 is not a ceiling. It's a checkpoint in a world where paper promises are questioned and real value is rediscovered the hard way. The global financial system is flashing currency crisis signals that are impossible to ignore, if you know where to look. Governments are drowning in unpayable debt, and this is no longer a theoretical problem. It is a mathematical one. Sovereign balance sheets have crossed a point of no return where growth cannot outpace interest, and austerity is politically impossible. When debt cannot be paid honestly, it is always paid indirectly through currency destruction. Bond markets are the first to feel this pressure. When investors begin to question whether they will be repaid in real purchasing power, demand weakens, yields spike, and central banks are forced to intervene. That intervention, printing money to buy debt, is the quiet admission that the system cannot sustain itself. Every emergency bond purchase is a signal flare. Confidence is failing. At the same time, currencies are being weaponized. Trade wars, sanctions, and capital controls are no longer fringe tools, they are standard policy. This turns money itself into a geopolitical risk. When nations realize their reserves can be frozen or devalued overnight, trust in the global currency system fractures. In that environment, neutral assets with no political allegiance become essential. Silver thrives in that vacuum. What makes this moment different is synchronization. Debt stress is not isolated to one country or one region, it is global. Major economies are weakening simultaneously, leaving no safe fiat refuge. Historically, this is when precious metals break free from suppression and reassert their role as monetary anchors. Silver responds to currency crises not because it is fashionable, but because it is outside the system. It carries no promise, no counterparty, no policy risk. As currencies lose credibility, silver gains gravity. This is not speculation. It is the same transfer of trust that has occurred in every debt-driven reset in history. When money fails, silver remembers what it is. Inflation is no longer a temporary side effect. It is the core strategy. Central banks are trapped, and the only tool they have left is money creation disguised as policy management. Every speech about cooling inflation is followed by liquidity injections, balance sheet expansion, and emergency backstops the moment markets wobble. This is not control, this is desperation. When central banks print, they don't create wealth, they redistribute pain. Purchasing power is quietly siphoned from savers, workers, and retirees and transferred to debtors and asset holders. This erosion happens slowly enough to avoid panic, but fast enough to destroy long-term trust. Inflation is not just rising prices, it is a silent tax, and it compounds relentlessly. What makes this phase dangerous is credibility loss. Once the public realizes inflation is structural, not cyclical, psychology shifts. People stop trusting official numbers. They stop believing reassurances. They stop holding currency longer than necessary. Money accelerates through the system, and velocity replaces patience. That is when inflation stops behaving politely and starts behaving emotionally. Central banks cannot stop this without detonating the debt market. Raising rates aggressively would collapse governments, housing, equities, and banks simultaneously. So they choose the lesser evil: currency dilution. Print now. Stabilize later. Promise discipline tomorrow. This choice is not neutral. It is inflationary by design. Silver thrives in this environment because it is immune to policy fiction. It cannot be printed, paused, or redefined. As currencies lose purchasing power, silver absorbs that loss and reflects it upward in price. Not gradually, but suddenly when denial breaks. Every historical inflation cycle ends the same way, with real assets reasserting value and paper claims exposed as fragile promises. Silver is not rising because it is speculative. It rises because money is failing. And when central banks choose printing over collapse, they guarantee one outcome: hard assets win, and silver remembers its role as money when everything else forgets. Silver is facing a supply crisis at the exact moment demand is becoming non-negotiable. This is not a cyclical shortage that can be solved with higher prices and quick production. It is a structural squeeze years in the making, now colliding with a world that requires more silver than it can physically produce. When supply and necessity collide, price is no longer optional. Silver is consumed by the engines of modern civilization. Solar panels, electric vehicles, power grids, data centers, medical equipment, and military systems all depend on silver's unmatched conductivity and reliability. This is not luxury demand. It is infrastructure demand. Governments can delay projects, but they cannot eliminate silver from the equation. There is no substitute that matches its efficiency, cost, and performance at scale. On the supply side, the picture is bleak. New silver discoveries are rare, and most silver is mined as a byproduct of other metals. That means production cannot simply be turned up when prices rise. Mining timelines stretch over decades, costs are rising, and ore grades are declining. Silver is being pulled from the ground slower than it is being consumed, and once used, much of it is gone forever. This creates a dangerous imbalance. Industrial users are starting to compete with investors for a shrinking pool of physical metal. When manufacturers panic, they don't negotiate, they stockpile. That behavior removes supply from the market instantly and forces price discovery higher, fast, and disorderly. This is how shortages become explosions. Silver doesn't need investor excitement to rise, it only needs industrial fear. And when the world realizes it cannot electrify, digitize, or defend itself without silver, price becomes irrelevant. Availability becomes everything. Every major silver bull market in history has followed the same script: dismissal, distortion, then detonation. Silver is ignored while pressure builds, suppressed while demand rises, and finally unleashed when the system can no longer contain it. What we are seeing today mirrors those past cycles with eerie precision, but on a far larger scale. In previous silver bull runs, the trigger was always monetary stress: currency debasement in the 1970s, inflation and geopolitical tension, loss of confidence in financial leadership. Each time, silver was treated as an afterthought right until it became the best performing asset on the planet. The lesson is brutal and consistent. Silver moves last, and then it moves fastest. But this cycle is different in one critical way. Everything is bigger. Debt levels are multiples of what they were in past bull markets. Derivatives exposure is exponentially larger. Paper silver claims now dwarf physical availability. In earlier cycles, there was still slack in the system. Today, there is none. The margin for error has vanished. Historically, silver bull markets end not with euphoria, but with shortages. Investors and industries scramble simultaneously, exposing how little physical metal actually exists. That scramble forces prices to leap, not climb. Resistance levels evaporate. Volatility explodes. Silver does not wait for consensus. It creates it through shock. Another key pattern repeats: public disbelief. In every bull market, silver is mocked at the lows and feared at the highs. The biggest gains occur while sentiment is still skeptical. That is exactly where we are now. Silence, neglect, and boredom dominate the narrative, right before history rhymes. When you line up the data, the cycles, and the structural pressures, one conclusion becomes unavoidable. This is not a repeat, it is an amplification. Silver has done this before. The only difference now is the scale of the stress behind it. The silver move will not begin with a headline, it will begin with a sequence. Markets don't break all at once. They fracture in stages, each one tightening pressure until the final release becomes inevitable. Understanding the timeline is not about dates on a calendar. It's about recognizing when the system quietly shifts from control to chaos. Phase 1 is suppression and disbelief. Paper markets dominate price, volatility is contained, and confidence appears intact. Silver trades sideways while fundamentals worsen underneath. This phase lulls investors into complacency. It feels boring. That boredom is intentional. It is the silence before stress becomes visible. Phase 2 is physical strain. Inventories begin to thin, delivery times extend, and premiums rise quietly in the real world, away from screens. Industrial users start locking in supply. This is the phase where insiders act while the public still sleeps. Price has not exploded yet, but availability has changed. Phase 3 is panic at the industrial level. Manufacturers realize supply is not guaranteed. Stockpiling replaces efficiency. Contracts replace spot buying. This behavior removes metal from circulation and exposes the lie of endless liquidity. The market tightens suddenly. Price begins to move, but it is still misunderstood. Phase 4 is monetary stress. A currency shock, bond crisis, or policy failure accelerates fear. Capital looks for safety, and silver, small, scarce, and underowned, cannot absorb the demand. This is where price breaks free from models and forecasts. Phase 5 is repricing, not trading. Repricing. Silver does not climb, it resets. And once this phase begins, there is no rewind, only realization. The next silver explosion will not be triggered by hype, it will be triggered by failure. Markets can tolerate bad news. They cannot tolerate loss of confidence. Silver moves when something foundational breaks, when the system reveals it cannot deliver on its promises. And history shows that the spark is rarely announced in advance. One possible trigger is a bond market fracture. When a major government fails to attract real buyers for its debt, central banks step in as the buyer of last resort. That moment signals the end of honest price discovery. Once investors realize bonds are being propped up with freshly created money, trust evaporates. Capital begins to flee from promises into proof, and silver becomes a magnet. Another trigger is a currency shock. A sudden devaluation, capital control, or loss of reserve status sends a message the world understands instantly. Money is political, and politics can change overnight. When currencies wobble, silver doesn't debate, it reacts. Its neutrality becomes priceless. A third trigger is a physical supply failure, a missed delivery, a force majeure at a major exchange, or industrial users unable to secure metal exposes the paper illusion. When the market discovers that claims exceed reality, silver detaches from futures pricing and seeks equilibrium higher. Finally, the most dangerous trigger is psychological. When people stop believing reassurances, when official narratives fail, when temporary becomes permanent. That moment cannot be reversed with speeches or rate cuts. Silver explodes when confidence collapses, not slowly, not politely, but all at once. And by the time the trigger is obvious, the move is already over. Silver is volatile by nature because it is honest. It exposes stress, fear, and distortion faster than almost any other asset. That volatility is not a flaw. It is a signal. But it is also why silver is constantly managed, restrained, and pushed down through paper mechanisms designed to mute its warning. Manipulation exists not because silver is weak, but because it is dangerous to the narrative. Paper markets allow massive leverage to be created at the click of a button. Futures contracts multiply claims on silver far beyond what physically exists. This creates artificial supply, suppressing price and shaking out impatient holders. But paper control only works as long as physical delivery is not demanded. Once that demand rises, leverage turns from a weapon into a liability. The risk investors must understand is timing. Silver can remain distorted longer than logic suggests. Prices can fall even when fundamentals improve. This tests conviction and punishes emotion. That is not an accident. It is how confidence is broken before repricing begins. Yet manipulation has a shelf life. It always ends the same way, with shortages. When physical metal becomes scarce, paper promises lose authority. Exchanges settle in cash. Premiums detach from spot prices. The market splits into two realities, paper silver and real silver, and price discovery migrates to the physical side. True risk is not volatility. True risk is believing a suppressed price reflects real value. Silver's swings are violent because it is trapped under pressure. When that pressure releases, volatility moves upward, not down. For prepared investors, understanding manipulation is empowering, not frightening. It explains the noise, the false breakdowns, the sudden reversals, and it clarifies one truth. Silver cannot be controlled indefinitely. When the system is stressed enough, silver does not ask permission to move. It reclaims its role and volatility becomes the price of honesty. Preparing for silver is not about speculation, it is about positioning. The biggest mistake investors make is waiting for confirmation. By the time silver's move feels safe, the opportunity is already gone. Silver rewards foresight, not reaction. It favors those who act while doubt is still dominant and conviction still feels uncomfortable. The first step is understanding what you actually own. Paper exposure behaves nothing like physical metal in a crisis. ETFs, futures, and unallocated accounts carry counterparty risk, liquidity risk, and policy risk. They rely on the system functioning. Physical silver does not. It stands outside balance sheets, outside promises, outside policy decisions. In a stress event, that difference becomes everything. Preparation also means emotional discipline. Silver will test patience before it rewards conviction. Price swings are designed to exhaust weak hands and shake confidence. Investors who survive understand volatility as noise, not signal. They focus on fundamentals, scarcity, demand, and monetary pressure, not daily price action. Another critical element is scale. Silver's market is small, and that works in favor of prepared investors. Even modest shifts in capital can cause dramatic price moves. You don't need the crowd. You need positioning before the crowd realizes it needs silver. Finally, preparation is mental. Understand why you hold silver, not for excitement, not for trends, but as insurance against monetary failure and systemic risk. When fear hits, clarity matters. Panic buyers pay the highest prices. Prepared investors already hold what others suddenly need. Silver does not announce its moment. It arrives when confidence breaks. Preparing now is not pessimism. It is prudence. And in every major financial reset, prudence has been rewarded while complacency has been punished.